Hey everybody, Marty Mazzora here, April 5th, Friday, 2024 with your weekly economic update. Clients, this will come to you Monday morning, linked to an email as Monday's message. Weekend commitments require that I keep this one very short and sweet. I think most of you will probably appreciate that based on how I typically can ramble on and on and on. But anyway, so yeah, good news for you that if you normally stick with me through the duration, good news for you that I indeed have to keep it quick this morning. But it's a really big morning and really important stuff, so I just want to kind of focus on what matters. If you had told me that the headline jobs number would be 303,000 this morning, which was 73,000 better than the highest estimate, with a consensus estimate of 200,000, unemployment rate dropping to 3.8%, yada, yada, I would have said the stock market would have another day like it did yesterday. Well, that is utterly not the case. The stock market is having the opposite, not quite getting it all back, but the opposite of what it did yesterday. Now, yesterday, when I recorded the morning video, the market was actually higher. So if you watch that video, clients that you received this morning, I think I was talking at the time about a market being up. That market rolled over hard yesterday. It was probably a 2% peak to trough decline. I think it certainly was maybe even more than that on the NASDAQ. Dow down 500 and some odd points. And that came on the heels of two things. One was a sharp spike in oil prices. Had something to do with that. And Fed governor, non-voting member this year, Neil Kashkari, saying, hey, we may not even need to cut interest rates this year. Stocks rolled over very hard. This market seems to be reacting quickly and sometimes in a not small way to virtually every sentence uttered by someone who's on the Federal Reserve Board. So what gives? How could we have had such a hot number? Everybody's afraid that the Fed isn't going to cut interest rates this year. At least the market reacts to any hint that they're not going to. Why isn't the market rolling over hugely? Well, these kinds of prints, I will say often the first reaction is not the ultimate reaction. So we'll see in the course of today and early next week if this gets digested any differently. I do think it'll be the follow-up commentary from the powers that be with interest rates and what they have to say, about it going forward. And then actually when you dig in the report a little bit, then you say, okay, so what really should the Fed be looking at? The headline jobs number, or should they be looking at wages, i.e. inflation of wages? And the answer would be you'd expect them to be looking mostly at wages. And I think the market knows that. Well, wages came in as expected. And that was at a 0.3% increase. And now I will say that last month's was revised from 0.1% to 0.2%, so that wasn't great, but they did come in at expectations. I think if you look at how the market reacted yesterday, clearly I think fear was that all of this was going to be worse from an inflation standpoint, certainly better from an economic standpoint, right? If people are making more money and you have more jobs. And I will say that the prior month in terms of the headline jobs number was actually revised down by 5,000 from 275 down to 270. So that would be a net positive for those who are fearing a rate hike from the Fed. So anyway, I'll dig into the details, and that's where we'll spend most of our time today. There's just a few other points I want to make. One of them is a not small point as far as we're concerned. This is our General Conditions Index. And I've been talking about how it's been trending better. Folks, it just popped again. We're just barely in the negative by 2 points. And when we're in the negative, we say odds favor recession over expansion and vice versa. It's been a real good indicator for us. We created it back in July of 2017, but we back tested it and so on. And right now, another week like we just had in terms of the data, and we're going to be back in the green. Now, being at the zero line is nothing to go throw a party about. It just says that the odds of expansion and contraction over the coming foreseeable future, if you will, are even. So again, it certainly wouldn't let the pigeons loose right there. But what we're looking for is improvement and rate of change. As for equity markets, which of course is on most people's minds, there's the conundrum, right? If things are getting better and the Fed's not going to cut rates, are we going to have another replay of 2022 where inflationary forces inspire, a 30% drop in stocks? Or is it the soft landing? Market's kind of acting like it's a soft landing, like we can get the best of both worlds. We can have the Fed bringing interest rates back down to some reasonable level. I'm using air quotes. And we're not going to get rampant inflation. I've shared with you our structural inflationary theme. It's going to encompass the next number of years/decades, and that is a very solid thesis, we think. And as I said last time, and that's actually necessary when you look at the whole debt construct of the United States. And it comes from populism and deglobalization, all these kinds of things as well would be the cause. One of the effects would be that if you can grow the economy through inflation, you can get out from under a north of 100% debt to GDP ratio, which is what played out in the 40s, although the Fed actually purposely kind of capped interest rates out the curve to allow the economy to grow and the debt to be refinanced and deficits to be financed at low interest rates relative to the growth in the economy. You do that long enough and you end up back below 100% debt to GDP. So I've beaten that horse to death probably over the last couple of years, but it's going to be the narrative, I think, going forward. And by the way, that's a very investment-rich narrative. We know how to invest in a weaker dollar, somewhat inflationary regime, but we've got this cycle to play out. We're a very late cycle. As better as this has been, recession odds are still way too high for comfort. Earnings are pricing in no recession, immaculate beauty, soft landing, what have you. That's a sketchy narrative, and stocks are way out over their skis from a valuation standpoint. We do think there are values out there. Our core portfolio is really designed to weather, all storms and so on. As I've been telling you of late, the technical sentiment really tell us that a correction is very highly likely over the next few weeks. We may want to exploit that to some degree, but ultimately, if we're going to have a recession, this market gets a lot worse before it gets better. So that's really what we need to continue to calculate, engage, and anticipate, not only with our own resources and our own research, which we dive very deep with, also with the economists and analysts who we respect so much that we pay a not small amount for all of their research to augment what we do, to challenge our own theses, and so forth. So, without further ado, I promise I need to keep this quick, which I actually do. So let's just jump to, we got to talk about the ISMs. So manufacturing has been in a contraction according to the Institute for Supply Management survey for 16 months running, and it just popped back into the positive. Wow, that's pretty amazing, right? That went to green. That improved our overall score. I will say, though, that we have to be careful. My experience over the years, and these charts pretty much prove it, you do get head fakes, right? Here we got a head fake right before the 2008 recession. It was all rolling over, had a nice little pop, and then we had, the worst recession since the Great Depression. And before everything began to roll over during the tech bubble recession, you can see manufacturing and everything was on the rise. Before COVID, you can see it as well. And then you can also see that services are still expanding, but at a slower clip on a month-over-month basis. So services, as you can see here, and that's the biggest part of the economy, are kind of trending in the wrong direction. So while this is picking up, this is coming back down. We've got to be careful with that, right? Because if services dip into recession, that means people have really pulled in. And I've talked about credit card delinquencies and auto loan delinquencies. Maybe that's happening. Suddenly that PWA index is going to start turning in the wrong direction, and recession will be upon us. So again, folks, stay tuned. Lots of mixed signals. We will get through what's left in this cycle. We just need to manage it prudently along the way. Okay, so let's get to the employment number. So non-farm payrolls, as I mentioned, 303,000. Unemployment ticked down to 3.8. Average hourly earnings, 4.1% year over year. That still looks inflationary to me. 0.3% increase is exactly what was expected. And so again, the market didn't need to react to that. The quits rate actually goes from 2.1 to 2.2. A rising quits rate is actually positive for the economy, but you can see what the trend has been. Job openings, as you can see, continue to contract. U6 unemployment which includes discouraged workers and so forth. Looks like it ticked up just a bit, or maybe it was flat at 7.3. So I really think it's that wage number, if nothing else. The other thing that this morning came out, and it did seem like maybe I'd have to look at a chart that the market reacted to that, and that is Manheim's used vehicle index is widely watched and very respected and does speak to inflation, fell in March, and that came out at like 7 a.m. Pacific time this morning. And that's good news, of course, for consumers. It's good news for inflation readings and so forth. Used cars have had almost a 3% weight in overall consumer prices. So there's some signs, and there are other signs that inflation is abating. And, and if our weak economy call is the right call, well, inflation is going to come down. But ultimately, if the economy slows into recession, we have to be prepared for that, because that's where it gets really ugly for the stock market. But again, right now, I get that people are more sanguine, and our index says that we should be more sanguine about recession risk, at least in the immediate offing. And I will say, and I just don't have time to pull up all the other information, but there are still really weakening signals underneath the surface. One thing I don't have on the chart here is that full-time employment is waning. Permanent job losers continue to increase. And then among small businesses, the rate of hiring continues to roll over. And remember, small businesses employ like 60% of Americans. I'm going to talk about that next week. I tend to bring that out when I get all of the NFIB data. For whatever reason, they give you the hiring data a week early. That was released this week, and it was kind of ugly. That's a sign of weakness in the economy. There's more that I could dig at below the surface. 37% of our data points read positive, 32% read negative, 38% read neutral. And then lastly, let's just look at commodities. Remember, folks, I've been pointing to bullish charts on commodities. This is the Bloomberg Commodity Index. That says good things about the economy probably as well, the global economy. Doesn't say good things about people who are worried about inflation risk. Copper, as you can see, I've been pointing right here to a very bullish divergence. We were pointing that out down here at these lows, and look what the price of copper has done since then. I think I mentioned last time that we've been having a pretty good run in our core portfolio, and it's been as much about commodities, frankly, as it has been about stocks. Gold's been very interesting of late, really bucking the trend. You'd think that with inflationary pressures, the way gold's been trading, at least in the short run, that would actually be a negative for gold. Gold has really had quite the ramp. Some of it's technical. It's broken out into all-time highs. There's certainly momentum behind that. Clearly, central banks are really engaging and buying gold maybe to diversify a bit more away from the dollar. But anyway, and gold's not a small chunk in our core portfolio, so that's been helping as well. So folks, I have to throw a hard stop at you right there, but a lot going on. It's going to be very interesting. I'm really more interested in seeing, in terms of equities, how we go into next week. We'll see. I guess I'm a little skeptical about this little rally that we're having today. Here's how the week looks. You can see it's quite the comeback from the big drop, peak to trough from yesterday. Looks like it's retraced about half of that. I think that's about what the Dow has done. Still down about 1% on the week, and the day is still young as I record this video, and I'll leave it there. Folks, thank you, of course, as always, for watching and listening, and I'll talk to you next week. Take care. Bye-bye.